Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. We have a really critical deep dive mission today. We're pulling apart a stack of headlines from CNBC, Bloomberg, Reuters, you name it.
Yeah.
Because the market is being pulled in two very different directions right now.
It really is. On one hand, you have this huge sense of relief over a political breakthrough here in the U.S.
And on the other, just this relentless churn of speculation and big strategic shifts within the AI sector.
That tension is exactly what we need to unpack. Our goal here is to get to the why behind these moves for you, because what the sources are revealing is a major shift in sentiment.
Focused on what exactly?
It's focused squarely on the end of the U.S. government shutdown, the, let's say, stability of the AI trade, and then these crucial global trade talks. We're going to try and move past just the raw numbers.
Right. And get into capital flow, some of those valuation jitters, and even some long-term risks that are, kind of hidden in plain sight. Okay, let's start with the good news, the immediate catalyst. It seems like the positive momentum is all coming from the expected end of this government shutdown.
Yeah, which has been dragging on for, what was it? Yahoo Finance said 41 days since October 1st.
Wow, 41 days.
It's the definition of instantaneous relief. You just saw this powerful risk-on tone emerge late Monday.
All based on the confidence that the government will be fully funded.
Exactly. The Senate passed the bill, cleared that big procedural hurdle, and President Trump has already given his approval. So the expectation is it just sails through the House.
And the details here really matter, especially for the air travel system. I saw on CNBC that the bill funds everything until January 30th of next year.
And critically, it includes back pay.
Which is huge. We saw nearly 2,000 flight cancellations on Monday alone. A lot of that driven by air traffic controllers who just can't work without a paycheck.
Right. And according to the sources, President Trump was very direct about that, demanding they return immediately or face significant pay docking.
So with that political stability coming back, capital immediately started moving.
It fled safety. If you look at the Treasury market data from Bloomberg, the benchmark 10-year yield jumped more than 2 basis points.
Up to over 4.12%.
Which is a classic risk-on signal. Money is flowing out of safe havens like treasuries and right back into stocks.
Jim Cramer on CNBC really summed it up. He just said the consensus is it's back to business as usual.
And back to business has some huge practical implications.
You're talking about all that delayed economic data.
Exactly. The government can finally release the jobs report, the inflation figures. This is the big economic temperature check that investors have been desperate for.
And beyond that, I saw both Yahoo Finance and Bloomberg reporting a renewed hope for IPOs.
Yes, a trickle of them, even before Thanksgiving. We might see listings from Medline, BitGo Holdings, maybe even Klook Technology.
That IPO pipeline reopening, that's the ultimate confirmation that confidence is really back.
It is. It's a huge green light.
Okay, so let's shift to the second massive tailwind from yesterday, which was just pure, unadulterated AI optimism.
Oh, absolutely. Wall Street fully embraced that narrative.
The Nasdaq jumped 2.27%.
Yeah.
The S&P was up over 1.5%. You saw Nvidia surge 5.8%, Alphabet up 4%.
And Microsoft finally broke its 8-day losing streak, climbing almost 2%.
That was its longest consecutive decline since 2011, wasn't it?
It was, so a big reversal. But here's the central contradiction that our deep dive really uncovered, and it comes from SoftBank,
the huge Japanese conglomerate.
One of the biggest AI investors on the planet. According to both Bloomberg and CNBC, they sold their entire stake in NVIDIA.
Wait, what? They sold out of NVIDIA, the most central player in the whole AI hardware boom.
For $5.83 billion back in October.
That seems like a massive vote of no confidence, especially while the rest of the market is rallying on AI hopes.
That's the surface reading, for sure. But the deeper story here isn't about distrusting NVIDIA. It's about a strategic pivot.
The pivot to what?
From passively holding equity to actively controlling infrastructure. SoftBank's CFO was clear. He said the sale was for capital utilization.
So they needed the cash.
They need a lot of it. New Street research analysts pointed out the company needs over $30 billion for its Q4 investments.
And where is that money going?
Well, a staggering $22.5 billion is for their investment in OpenAI. Another $6.5 billion is to acquire Ampere Computing, the U.S. chip designer.
So they're liquidating one massive AI win to fund the next wave, trading stock for infrastructure.
That's the play. And it explains why SoftBank's own results look so good. CNBC reported a surprise net income in Q2, mainly from a colossal $19 billion gain in its Vision Fund.
Driven by OpenAI.
Almost entirely. They also announced a 4-for-1 stock split, to make the shares more accessible. That's a very bullish long-term signal.
But even with SoftBank making these huge strategic moves, the sector isn't without risk.
No, not at all. And Reuters had a great piece detailing the struggles at CoreWeave.
They're an NVIDIA-backed firm, right? They rent out GPUs.
Correct. And their shares plunged nearly 9% pre-market. They beat on revenue, but their forward guidance was disappointing.
Why? What was the issue?
Data center delays. And that brings up the question, is this just one company hitting a snag? Or is it something more systemic?
A warning for the whole AI infrastructure boom.
That's the question Barclays analysts are asking. They see it as highlighting a very real operational risk in scaling this young, capital-intensive sector.
And we're seeing caution from the supply chain, too. Yahoo Finance noted that TSMC, NVIDIA's main chipmaker, posted its slowest monthly revenue growth in over a year.
Yeah, only a 16.9% rise in October sales. When the foundation, TSMC, starts showing some strain, it just fuels those bubble concerns.
Still, you look at a major player like UBS, and they are extremely bullish.
Extremely. They just raised their S&P 500 forecast to 7,500 by the end of 2026.
And that's driven specifically by AI.
By AI momentum and corporate profits, yes. Their key point, and their CIO Mark Hayfield made this clear, is that the market will broaden beyond just the mega caps.
And what about the bubble fears?
They don't think that the drama of a bubble inflating and exploding isn't inevitable. That's the direct quote. They see a path for sustainable growth.
Okay, let's move to the macro landscape. How is all this optimism around the shutdown playing against, global rates and inflation?
It's interesting because despite the stock rally, gold is still showing a lot of underlying strength. Bloomberg noted it extended gains, rising to around $4,140 an ounce.
So gold is acting as a hedge.
Exactly. It's a hedge against the expectation that all this delayed economic data, once it drops, will confirm a worsening outlook.
Which would force the Fed to cut rates.
Precisely. And bullion's appeal is also getting a boost from some underlying fiscal concerns here in the U.S.
Like the idea of a tariff dividend check. Can you just explain that concept for us?
Of course.
Yeah.
It's a political idea, President Trump has floated it, where the money collected from tariffs gets returned directly to citizens as a check.
To offset the higher prices consumers pay.
That's the idea. Whether it's feasible or not is another debate, but just the mention of it reinforces this idea of financial instability, which is always good for gold.
And this is all supported by what Fed Governor Stephen Miron told CNBC.
Right. He said a half-point rate cut for December is appropriate because policy needs to look at where the economy is going, not just where it is now.
Okay, let's turn to some of the key U.S. trade negotiations. First up, Switzerland.
Yes, a big development there. They're nearing a deal to reduce that punitive 39% tariff that was imposed back in August.
And they're trying to get it down to 15% to match the EU rate.
That's the goal. And the news, according to both CNBC and Bloomberg, immediately sent Swiss stocks higher, especially the luxury sector.
Richemont, Swatch Group.
All of them. Removing that tariff is a huge boost for their exports.
And we're seeing similar talks with India. President Trump signaled he's getting pretty close to a deal there.
And he was very explicit, tying a reduction in their high tariffs, some of which are at 50%, to something else.
India's purchasing of Russian oil.
Yes. Bloomberg reports he cited their reduced purchases as a key factor. It's a fascinating use of trade relief to push foreign policy goals.
But there's a bit of nuance there, isn't there?
There is. You have to look at the data. The research firm Kepler, reported by CNBC, suggests India's imports of Russian crude in October were actually flat compared to September.
So the political justification might not perfectly match what's happening on the ground.
It might not. A small but important detail.
Finally, what about the ongoing tensions with China, specifically for U.S. farmers?
It's still a major issue. CNBC featured an Illinois soybean farmer, Scott Gaffner, who's part of a push to boost sales in China.
Where there's still a 13% tariff on U.S. soybeans.
Right. And China has promised future purchases 12 million metric tons this year, 25 million over the next 3. But even that is still below the almost 27 million tons the U.S. sold in 2024. The tariffs are still hurting.
Okay, let's pivot to some corporate activity. starting with a big governance fight over in Japan.
A really significant one. Bloomberg is reporting that Elliott Investment Management, the activist investor, has taken a large stake in Toyota Industries.
And they're challenging something.
They are. They're challenging the proposed privatization price. They're saying 16,300 yen per share is just too low.
Why? What's their argument?
It's all about transparency and undervaluation. Elliott believes the company's financials aren't clear enough, and more importantly, that its cross-shareholdings in other major firms are vastly undervalued on the books.
So it's a classic activist move to unlock hidden value.
Exactly that.
And speaking of corporate drama, the final vote on Elon Musk's pay package. It went through, but with a few wrinkles.
It did pass, but support is definitely waning. CNBC noted that among non-insider shareholders, support dropped to about 67%, down from 73% for his 2018 package.
So there's some growing shareholder fatigue there.
You could say that, especially since top proxy advisors recommended voting against it.
Now, something else you flagged. A structural risk that's being presented as an affordability solution. The 50-year mortgage.
Yes, Yahoo Finance detailed the debate around this idea, which President Trump has floated, and the immediate appeal is obvious.
Lower monthly payments.
Much lower. On a median $415,000 home, your payment drops from about $2,038 a month to just $8,802.
That does sound very appealing up front, but I imagine the long-term math is pretty staggering.
It is truly shocking. Experts are warning that by extending the term, you nearly double the total interest paid.
Double it.
Over 50 years, you'd pay $749,000 in interest. That's compared to about $402,000 over 30 years. You're basically paying double for the house, just in interest.
That's incredible.
And Joel Berner at Realtor.com made a great point. A policy that just boosts demand without addressing the chronic lack of housing supply. Well, it just risks driving home prices even higher.
A huge long-term consequence hidden behind a short-term promise.
Precisely. And finally, let's touch on a new systemic risk that global regulators are flagging.
Okay.
Reuters reports that IOSCO, the global securities regulator, issued a stark warning about tokenized assets. You know, crypto tokens linked to real financial assets.
And what's the specific risk they're worried about?
The main thing is investor confusion.
Confusion over what exactly?
Confusion over whether they actually own the underlying asset or if they just own the token that represents it. And that's a huge distinction.
I see. And there are other risks.
Yes, counterparty risk. From the third-party issuers who stand between the actual asset and the person holding the token, IOSCO basically concluded that for all the hype, the efficiency gains here are still uneven. People are still relying on traditional finance to get anything done.
Okay, so let's circle back and wrap this all up. What's the main takeaway from this deep dive?
Well, the biggest driver is clearly political. The relief from the shutdown is boosting confidence, but just underneath that surface.
You have SoftBank making this incredibly strategic cash out, moving from passive stock ownership to active control of AI infrastructure.
Right. And at the same time, you see these growing pressure points everywhere. Contradictory trade politics, huge long-term financial risks hidden in products like that 50-year mortgage.
And the general murkiness of new things like tokenized assets.
So the biggest question now, and the one I think you should really consider, goes right back to the government reopening.
Okay.
We are about to be flooded with all that key economic data we've been missing. The market consensus right now is that the data will show a worsening outlook, which supports Fed rate cuts.
But what if it doesn't?
Exactly. What happens if the jobs numbers, the inflation reports? What if they prove to be surprisingly resilient? How quickly would that shock force a rapid recalibration of the market? How fast could it reverse this powerful AI-driven momentum we've seen?
We'll see you all tomorrow morning with new headlines from major financial magazines.